The most excruciating pain in this business isn't a financial loss, it's the agony of a missed opportunity. It is the feeling of selling a position for a small, tidy profit, only to watch it climb day after day, week after week, until it becomes the legendary winner you dreamed of, but you are no longer a part of the journey. You are left on the platform, clutching a tiny ticket, while the express train to fortune disappears over the horizon. This single, recurring mistake, born from fear and impatience, is what separates the fleeting participant from the enduring professional. The crowd is obsessed with the art of buying, but the real masters are students of the art of sitting. The greatest fortunes are not made through frantic activity, but through disciplined, unwavering patience during a major trend. Today we dissect the 5 foundational rules for staying in a winning trade, for transforming a nervous scalp into a life-altering position. The impulse to sell a winner prematurely is one of the most powerful and destructive psychological forces a market participant will ever face. It stems from a deep-seated fear of giving back what has been gained. When a position shows a profit, the mind immediately frames it as my money. Any small dip, any normal pullback is then perceived not as a fluctuation, but as a direct threat, a thief trying to steal what is rightfully yours. This triggers a fight-or-flight response. The heart beats faster, the palms sweat, and the overwhelming urge is to press the sell button to eliminate the threat and secure the small gain. This provides immediate relief, a sense of control, but it is a trap. It is the market's oldest and most effective trick. It conditions you to think small, to be content with crumbs, while the feast continues just out of reach. Jesse Livermore stated that his greatest triumphs came not from his brilliant market calls, but from his courage to sit tight on them. He understood that the human mind is not wired for trend following. Our minds are wired for immediate gratification and threat avoidance. Therefore, to succeed, one must operate with a set of logical rules that override these flawed primal instincts. The market is a river, and your job is not to fight the current, but to ride it for as long as it flows strongly in your favor. The market structure is deliberately designed to shake you from your position. Understand this. A trend does not move in a straight line. It moves in a series of impulses and reactions, waves of buying and waves of selling. Imagine it as a grand staircase. There is a step up, followed by a small, flat landing, then another step up. The uninformed participant sees the landing and panics, thinking the climb is over. The professional understands the landing is where the market catches its breath, where it builds the energy necessary for the next ascent. These pullbacks, these minor fluctuations, are the engine of the trend. They serve a critical mechanical purpose. They shake out the weak hands, those who bought late, have their stops too tight, or are operating on pure emotion. This transfer of shares from impatient, fearful participants to calm, patient, large operators is what fuels the next move higher. The composite man, Wyckoff's brilliant personification of the market's institutional mind, does not want to carry a crowd of followers on his back. He will periodically buck and shake the trend to dislodge as many as possible before the real explosive part of the move begins. So, when you feel that intense urge to sell during a minor dip, recognize it for what it is, a manufactured test of your conviction. The market is asking you, are you serious about this position, or are you just a tourist? Your response to that question, governed by rules instead of fear, will determine your ultimate success. Let's build a mental image of a healthy, enduring uptrend. Do not imagine a smooth 45-degree line rocketing upwards on a screen. That is an illusion, a sign of an unsustainable mania that will end badly. Instead, visualize the process of a skilled mountaineer climbing a great peak. He ascends for 100 feet, making strong progress. Then he stops. He finds a solid ledge. He hammers in pythons, secures his ropes, and rests. He might even climb down 10 feet to test his anchor. To an observer on the ground, it might look like he has stopped or even reversed course. But the mountaineer is not retreating. He is consolidating his gains. He is ensuring his foundation is secure before attempting the next more difficult section of the climb. This is precisely what a healthy stock does. It pushes to a new high on strong volume. This is the ascent. Then it pulls back on lighter, quieter volume. This is the rest on the ledge. The price may dip for a few days, drifting sideways. The key is to feel the character of this pullback. A low-volume pullback feels quiet, almost lazy. There is no urgency, no panic in the selling. It is the market taking a healthy pause. A dangerous pullback, in contrast, feels violent. The price drops sharply on volume that is as high, or even higher, than the volume on the preceding up move. This is not a mountaineer resting. This is him slipping. The price bars are long and red, closing near their lows. That is not a test. It is a sign of weakness, a signal that supply is overwhelming demand. Learning to distinguish between the quiet rest and the violent slip is the first step to developing the fortitude to stay with a winner. The first rule, the very bedrock of this entire philosophy, is to trust the major trend. Before you ever enter a trade, you must identify the primary direction of the market and your chosen stock. Is it in a clear pattern of higher highs and higher lows over a period of weeks or months? Is the path of least resistance clearly upwards? If you cannot answer this with a definitive yes, then you have no business being in the trade. The mistake of the crowd is to get lost in the noise of the day-to-day fluctuations. They stare at the 5-minute chart, agonizing over every small tick against them, while completely ignoring the powerful, overriding current of the weekly chart. This is like standing on the deck of a massive ocean liner, worrying about the small ripples at the side of the ship, while ignoring the fact that the entire vessel is steadily sailing from New York to London. Your job as a speculator is to align yourself with the direction of the liner, not to jump overboard every time a small wave hits the hull. To implement this rule, you must zoom out. Before your trading day begins, look at the weekly and daily charts. Reaffirm the major trend. Write it down on a piece of paper and stick it to your screen. The primary trend is UP. This simple act serves as a constant anchor, a reminder of the bigger picture. When a minor pullback occurs and fear begins to creep in, you look at that note. It forces you to ask, has this small dip actually changed the multi-month structure of higher highs and higher lows? In 99% of cases, the answer will be no. The trend remains intact. Your job is to remain with it. Rule number 2 is to learn to ignore minor fluctuations. This flows directly from the first rule but focuses on execution and emotional control. Once you have established the major trend, you must give the stock room to breathe. No market moves in a perfectly straight line. It will always ebb and flow. A normal, healthy pullback might retrace 1/3 to 1/2 of the prior upward move. This is standard behavior. The uninformed participant sees a 5% drop from the recent high and panics, thinking the top is in. The professional sees the same 5% drop and recognizes it as a potential opportunity, a test of a prior support level where new buyers might emerge. The key is to define what constitutes minor noise versus a genuine change of character. Before you enter the trade, you must accept that a certain amount of adverse movement is simply the cost of doing business. It is the price of admission for the potential of a large gain. If you are not mentally prepared to watch your position go from being up 10% to being up only 5% without panicking, you are not ready to capture a 100% gain. To put this into practice, you must shift your focus from price to structure. Instead of fixating on the dollar value of your account, focus on the integrity of the trend structure. Is the stock still making higher lows? Is it holding above a key prior peak which should now act as support? As long as the structure is sound, the minor price swings are irrelevant noise designed to test your resolve. Livermore called this sitting tight. It is not a passive act. It is an active, disciplined decision to trust your initial analysis and let the market do its work, filtering out the noise in favor of the signal. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding these foundational texts transforms trading from a guessing game into a logical, repeatable process. It gives you the framework to ignore the noise and focus on the market's true intentions, which are revealed not by news or opinion, but by price and volume alone. This brings us to the third and perhaps most powerful mechanical rule. Use a trailing stop, not a profit target. The very idea of a profit target is fundamentally flawed because it assumes you know how far a stock can run. You don't. No one does. Setting a rigid target, say for a 20% gain, is an act of ego. It is you telling the market what it should do. A professional listens to what the market is doing. By selling at a predetermined target, you might be right 20% of the time, but you will inevitably cut off the one trade that could have gone on to gain 200%. Those are the trades that build fortunes. A trailing stop, on the other hand, is a tool of humility and logic. It is a stop-loss order that is moved up as the price moves in your favor, but it is never moved down. Imagine a ratchet wrench that only clicks in one direction. It locks in gains while still giving the stock unlimited upside potential. This method keeps you in the trade as long as the trend is healthy and only takes you out when the price action proves the trend has reversed. For example, you buy a stock at $50. You place your initial protective stop at $47 based on a recent swing low. The stock rallies to $60 and forms a new, higher low at $56. You then manually trail your stop up to just below that new low, say to $55. You have now locked in $5 of profit, but more importantly, you have given the stock from 56 to infinity to continue its run. You are letting the market's own structure dictate your exit, not an arbitrary number you picked from thin air. This is the essence of Livermore's famous saying, "Cut your losses and let your winners run." A trailing stop automates this wisdom. The fourth rule is a diagnostic tool. Let volume confirm the health of the trend. Price tells you what is happening, but volume tells you the conviction behind it. Volume is the fuel in the engine of the market. A trend cannot sustain itself without it. During your time in a trade, your eyes should constantly be scanning the relationship between price and volume. This is Wyckoff's law of effort versus result. The effort is the volume, and the result is the price movement. In a healthy uptrend, you want to see increasing volume on the up moves, the impulse waves, and decreasing volume on the down moves, the pullbacks or reactions. Imagine pushing a heavy box across a room. When you are pushing hard, it moves forward. That is high effort, positive result. When you stop to rest, the box stops. That is no effort, no result. That is a healthy pause. Now imagine you are pushing with all your might, high volume, but the box barely moves forward, small price gain. This is a warning sign. It suggests a powerful counterforce is working against you. This is called churning, and it often happens at market tops. Conversely, if the box starts sliding backwards on its own with great speed, a sharp price drop, on high volume, it signals the trend has fundamentally changed. To apply this rule, during a pullback, the first thing you should analyze is the volume. Are the volume bars on the red days shorter than the volume bars on the preceding green days? If so, this is a low volume test, a sign that sellers are not aggressive. It's a sign of health, a green light to continue holding your position. If the volume on the pullback is high and expanding, it is a red flag. It is a sign of weakness. It doesn't mean you sell immediately, but it means your hand should be on the exit, ready to act if the price breaks a key support level. Our fifth and final rule is the synthesis of all the others. Sell only when the market provides a clear, objective sell signal, not when you are bored, scared, or greedy. Your exit from a trade should be just as logical and unemotional as your entry. It should not be based on a feeling, a news headline, or the fact that you've grown tired of waiting. You must have a predefined list of what constitutes a valid reason for sale. What do these signals look like? One of the most classic is the buying climax. This occurs after a long advance where the price suddenly surges upwards on the largest volume seen in months, yet the price closes far off its highs, or even down for the day. This indicates a massive transfer of shares from smart money to an ecstatic public. The institutions are unloading their inventory into the buying frenzy. Another signal is a clear change of character, where a key, established trend line is broken to the downside with a surge in volume. This is followed by a failure of the price to rally back above that broken trend line. The market has changed its behavior from bullish to bearish. A third signal could be the formation of a lower high followed by a lower low, which is the technical definition of a downtrend. The key is to write these objective exit criteria down in your trading plan. When you are in a position, you consult this list. Has a buying climax occurred? Has the trend structure broken? If the answer to all of your predefined exit rules is no, then you do nothing. You sit. This discipline prevents you from making the two most common errors: selling out of fear during a normal pullback and selling out of impatience during a healthy consolidation. You are waiting for the market itself to tell you that the party is over. Now, let us consider the scenarios where the market does not behave as expected. What if you are holding a position in a clear uptrend and it experiences a sudden, sharp pullback on very high volume? This violates Rule 4. The volume is not confirming the trend's health. This is not a minor fluctuation. It is a warning shot. In this case, you do not panic sell, but you must respect the message of the market. Your trailing stop, which should be placed below the most recent significant low, becomes your absolute line in the sand. The high volume drop is the market telling you that supply has entered the picture in a meaningful way. If the price continues down and triggers your trailing stop, you exit without question or regret. The purpose of the rules is not to keep you in a trade forever. It is to keep you in a trade as long as it is working and to get you out decisively when the evidence shows it is no longer working. The exit is clean. It protects your capital and your profits. You can then step aside and wait for the dust to settle. Perhaps it was just a violent shakeout and the stock will set up again. Or perhaps it was the beginning of a major trend reversal. Either way, by obeying the signal from price and volume and by honoring your stop, you have protected yourself from a potentially catastrophic loss. Another common scenario is the test of patience. What if the stock doesn't pull back violently, but instead goes completely quiet? It enters a sideways trading range for weeks or even months. You are sitting on a decent profit, but it is not growing. Boredom and impatience set in. The temptation to sell and move on to something more exciting becomes immense. This is where the rules again provide clarity. Is the stock still above its major trend line? Yes. Has it triggered your trailing stop, which is sitting below the low of this new trading range? No. Is the volume within the range drying up? If so, this is often a sign of reaccumulation. The composite man is quietly absorbing more shares before the next leg up. A trading range is a cause being built. The longer the cause, the more powerful the subsequent effect or trend. Your job is to wait for the resolution. You watch for signs of strength, like a jump across the creek where price breaks out of the top of the range on high volume. Or you watch for signs of weakness, like an upthrust, a false breakout that quickly fails. As long as the structure is neutral to positive and your stop is not hit, your default action is to do nothing. Patience in a consolidation is just as important as courage in a trend. By refusing to sell out of boredom, you position yourself to capture the next and often most explosive phase of the advance. In conclusion, the ability to hold a winning trade is not a magical talent, but a learned skill built on a foundation of objective rules. It requires a profound psychological shift, moving from a mindset of fear and a need for constant action to one of confidence and disciplined patience. It begins with trusting the major trend, refusing to be shaken out by the inevitable minor fluctuations that are merely the market taking a breath. It is executed mechanically through the logical application of a trailing stop, which protects profits while allowing for unlimited upside. Your conviction is constantly checked against the market's own language, the interplay of price and volume, which tells you if the trend remains healthy. And finally, your exit is not dictated by your own fickle emotions, but by the market itself, when it gives a clear, undeniable signal that the primary trend has concluded. By building a system around these principles, you erect a fortress of logic that protects you from your own worst enemy, your own impulsive human nature. You begin to operate not as a gambler hoping for a lucky outcome, but as a speculator, calmly executing a well-defined plan based on the observable probabilities of market behavior. This is the path to consistency. This is how small accounts are built into large ones. If you wish to understand more about the deep structure of the market and the timeless principles that govern its movements, stay with us. The journey to mastery is long, but it is a worthy one.